Hello, everyone's time again for the weekly trading link trading update. This week's market movements were quite favorable, exactly matching our analysis from last week. First, let's look at the most promising movement. Cryptocurrencies have shown 5 consecutive days of gains this week. Starting from Monday, the price rose from $62,000 to $68,860, and on Monday, it quickly and effectively broke the descending resistance line connecting the highs from June, July, and September. After this resistance line was broken, as we previously predicted, it is very likely that the price will quickly reach the $72,000 level. Last week, we anticipated that Bitcoin could have the opportunity to test its previous and annual highs before the US election. The general market sentiment is that, if Trump is elected, it could trigger an explosive boost for the cryptocurrency sector. The next target might be to break past $70,000 and reach $90,000, a highly anticipated figure in the market, $90,000. So, regarding how to operate, we recommend that during this week and the next 2 weeks, specifically before November 5th, if the price breaks through $72,000 and there is time before the election results, you can set a stop loss at $72,000 to hedge against a downward movement while speculating on further gains. For example, if the price continues to rise, wait for the breakout above the high point, then set the annual high as the base. When the price retraces and rises again, at that moment, you can set a low-cost stop loss. Everyone should consider how to hedge the downside risk of their spot holdings using contracts. After setting the stop loss at this position, continue to speculate on the upward trend, as the data leading up to November 5th may provide a safer opportunity. If the election results deviate from market expectations, the market may drop sharply. So, it is crucial to have a defensive strategy in place for this wave. The second asset class this week also surprised us, even exceeding general market expectations. During the last wave of gold's decline, we believed that this drop wasn't just a normal phase, as many major hedge funds had already exited their long positions in gold. However, we mentioned that entering long positions now could be premature. Why? Because when a true bear market occurs, there will always be a rapid rally in the market first. Last week, there were some key data points that didn't trigger such movements. This could be a sign of a major bear trend transformation. Because such bearish patterns haven't appeared, the bullish trend has continued. Now, if we look again, the gold rally remains very solid. After breaking above the 5-week moving average this week, and with the monthly adjustment being favorable, the next peak for gold is indeed difficult for anyone to predict. We believe that each day is writing a new chapter in history, and it's challenging to predict where the price will go next. However, as far as we know, many bearish traders are still struggling with their position. It's advisable to cut losses early and not go against the trend. This week, the most surprising market movement was in crude oil. It showed an unusually strange pattern. As everyone knows, after the geopolitical events last week, Friday saw a high-level sideways consolidation, and many traders continued to hold long positions. However, this week, as you can see, there was a gap down from last Friday to Monday, and another gap occurred between Monday and Tuesday's open. Looking at crude oil, such gaps on the daily chart level, excluding continuous contract rollovers, are very, very rare. However, given the complex geopolitical situation, crude oil has shown a pattern where major players deliberately suppress short positions, resulting in a very strong bearish pressure. This move is also a response to the geopolitical situation between Iran and Israel, aiming to de-escalate tensions. This drop caught the market somewhat off guard. If we look at the midterm trend on the monthly level, the price has fallen below both the weekly moving average and the 5-week moving average, with a drop of about $3.50. But in the latter half of the week, if the first half continues downward, do not blindly chase short positions, because if a bullish trend emerges, it could be a rapid rebound, happening very quickly. Therefore, trading crude oil this week remains very challenging. The first 4 days have mostly formed a narrow trading channel. You can see that over the 5 days this week, the market opened low and moved lower, which is not particularly uncommon, but such instances are quite rare. After closing, trading halted, and after reopening at 5 a.m. Singapore time, the price rapidly dropped by $3, falling from $74 to $71. This kind of movement is a once-in-a-decade event. If you were caught off guard by this short attack on crude oil, it's just bad luck, as this kind of market behavior is extremely rare. Over the past 4 days, the market has been showing a low-level sideways consolidation around 2045, with each low point being lower than the previous one. This is a deliberate short squeeze, with clear intent and action. The core reason behind this, in my view, is to stabilize the Middle East situation as the US presidential election approaches. Historically, Crude oil tends to follow a downtrend channel leading up to each presidential election. The geopolitical events from last week caused a short-term spike which is hard to sustain. We have analyzed these events before, and they are typical of geopolitical, quick, impulsive reactions. However, the overall crude oil price has a strong support level at $67, which is likely to hold over the coming weeks. It is unlikely to break quickly and drop to $60 or even $50. The probability of that happening is very low. The focus remains on the U.S. election, with an aim to prevent crude oil from reaching excessively high levels during the election period. Now, let's take a look at the recent trend in the U.S. dollar. After the Federal Reserve's interest rate cut, it appears that the Fed might shift its stance. The recent U.S. economic data has been overwhelmingly positive, and the dollar has regained its strength, preventing rapid capital outflow from the U.S. as the dollar quickly recovered, stabilizing from 170 and reaching the 104 level. Gold continued to strengthen. This historically rare negative correlation demonstrates that gold trading has indeed become very challenging lately, as it has detached from fundamental, technical, and historical patterns. This bullish wave is still difficult to navigate. For non-US currencies, the short-term trend remains bullish. The next resistance level might return here, causing a significant range-bound movement. When the dollar index breaks below 100, it shows that despite the Fed's rate cut, the expected rapid decline has not occurred as anticipated by the market. This wave of movement was somewhat unexpected, but the dollar index around 100 is indeed a historically strong support level. Moving forward, our focus remains on Bitcoin, as many traders and investors hold Bitcoin positions. In the past week, the overall trading performance has not been particularly favorable compared to before. Trading links traders did not have an ideal performance. Gold exhibited an extreme reverse trend this week, as did crude oil, while Bitcoin performed relatively well. Our trades as a whole still have potential for gains, but it's crucial to implement risk hedging strategies. For instance, consider how you can use futures contracts to hedge against the risk in spot positions. That concludes our overall analysis for this week. In the coming 1 or 2 weeks, the market may experience low overall trading volume, making it challenging to trade, while volatility is increasing. Trading volume is decreasing mainly due to some hedge funds and traders holding back because of insufficient market liquidity, which in turn amplifies volatility. Such market conditions are still difficult to trade in. If there are no specific needs, it is recommended to clear positions and wait before November 5th. Bitcoin spot holdings can still be maintained. As for crude oil, ignore the geopolitical factors for now and return to technical analysis and the dominant trading patterns. Focus on the Bollinger Bands on the daily chart level to trade within the range. A range between $67 and $72 can be used for this type of swing trading. That concludes our discussion for this week. Thank you all for listening.